on the recording. So let's welcome Mr. Vincent Soto from Celtic Capital. Vincent, the floor is yours.
Hey, thank you, everyone. Appreciate it. Thank you, Alan, for allowing me to present. And hello, everyone. Good evening. I'm sure it's already nighttime where you guys are at. So let me share my screen here. Great. So I want to dive in here and talk a little bit about AR financing. And thank you, Alan, for alluding to the market and the changes that are happening. With interest rates rising, it's becoming, and it may become harder for your standard businesses to obtain funding. As interest rates rise, payments are going to be higher, and businesses may not meet that cash flow requirement that they once used to with lower interest rates of around 3-4%. So I'm going to go ahead here and share a couple of items and share a little bit about what we do and how we can be a beneficial alternative financing resource for you and your clients. So we provide asset-based capital from 100,000 to 5 million. And what asset-based is, and the assets that we finance are accounts receivables, inventory, and equipment only. And you'll find that there are some businesses that are looking for lending and cannot obtain lending from their traditional sources, from big banks in general. Our targeted borrower are, like I mentioned, companies that are unable to obtain adequate traditional banking finance or continue with traditional banking finance. You may get calls from business owners that are looking to get their current deal refinanced from their current bank. And what happens is, as rates continue to rise, it might squeeze the business cash flow tighter and tighter as these rates rise. And the banks will look to get that deal worked out, meaning they'll ask their client to please find funding or please pay this off, or find someone to take this debt off of our books. And that's where we come in, and we've been very, very successful in being able to help bridge that gap for those certain clients. We're kind of industry agnostic, except for very few amounts. We fund all and only commercial businesses, except retailers, medical insurance, Medicare, Medicaid, so your doctors and physicians and healthcare practices and legal practices. They don't fit our niche, they don't fit our wheelhouse. Progress billers, those are your standard contractors, subcontractors. They do not fit our niche here. And it's because of the way they bill their clients and yes. So I'm going to move to the next slide here. So we do help business owners build the financial strength, and they need to qualify for traditional bank financing and as quickly as possible. So in every case is different, but we do, again, our bridge lenders, and we are looking to kind of fund their immediate needs as they work on their finances, work on maybe their balance sheet, maybe they weren't profitable last year, or the interest rate, like I said, are too high, and the minimum payment throws off their cash flow service, and they don't qualify. That's where we come in, and we help them by monitoring them month to month and help them get back to traditional financing. And with every deal that comes through, I will keep close contact with Alan. And once these businesses come back to being bankable 2 years, 3 years down the road, maybe even 1 year, you guys will have that first pick to be able to then find them traditional banking, which doubles your revenue, it doubles your incentive. So that's another good thing and a key point here to keep in mind. So our products are, we're very simple. So we do lines of credit for accounts receivable and inventory, and we have a term debt for equipment, just standalone equipment. It can utilize this capital for capital, equipment only, and we do have access to resources outside senior debt to accommodate more complex transactions. We do have 40 years of experience. We are very creative with our loan structures. We require no financial covenants, so our documentations that we need are very, very simple, very light, and we don't require any lockboxes. So traditionally, what this means is, in most cases, when there is an asset-based lender involved, or maybe you guys have heard of factoring, the payments must come from your business, your client's clients. They're now going not to the business, not to your client, but they're now going to a lender. We don't require that, as we still allow our clients to manage their own payments. So that is another beneficial thing for your clients. So what companies are we looking at here? So, businesses that are turned down by traditional lenders, banks. We will go 85% to their accounts receivables, 50% of their inventory, and 80% of their forced liquidation value of equipment. And that's very important, because a lot of people, they value their equipment at a fair market price. So we go towards the lowest end of that, which was called the forced liquidation value. Some businesses that are going through early stages, so they're very young, they don't qualify for traditional banking. They've experienced rapid growth that they've never seen before. There's no history behind it, and that's why they're getting turned down. Recent losses, substandard cash flow, delinquent taxes, personal credit issues, bank workout is something that we talked about earlier, where the banks are looking to get a deal off of their books, and past bankruptcy. We have a stomach for these clients. And again, we will facilitate a transition to your referrals when they become bankable. So, I keep close communication with Alan to make sure that when businesses have had enough time and have done their corrections, that they will go back to Sequoia, and you guys can then find them traditional lending with your already established contacts and resources. Now, I know I went through this pretty quickly here. I know it's pretty late for you guys, but I'm here and open for any questions that you guys may have, or I'd love to dive into a little bit more key points that I've talked about if needed.
Yeah, Vincent, let me jump in first, right? So you on this particular slide right here, you're talking about 50% inventory, 80% equipment. So can you emphasize a little bit about what kind of inventory you can lend on? So can you emphasize on that?
Yeah.
And what type of equipment that you can fund?
Yeah, so thank you for that. So the inventory, as long as it's something palatable for us, it could be anything from any of your clients, if it makes sense. For example, if you've got a paper factory or paper mill, and they've got raw material in their possession that they keep and hold and turn into a product that then turns into that AR that they're now charging a client for. Those are the inventories that we're looking to finance. And whatever that value is, we would go 50% of whatever they value that inventory. So, for example, if a client has $1 million in accounts receivable outstanding, then we would loan up to $850,000, and we would go half of that line tied to their inventory, right? So $425,000 on top of that, that's what we would get to. Inventory can be anything. It could be plastic products. It could be, like I said, paper, raw materials, even a finished product. That can be the inventory. Equipment. Equipment can be anything that the businesses use. So if we were talking about a transportation company, they may have tractor trailers. They may have a fleet of them. They may have 12, 8 semi-trucks, right? That's equipment that we can finance on. If they're manufacturers, they're producing metal products, they may have machining products, CNC machines, hot foil stampers, things like this, major big machinery, we will loan on. Even though I mentioned subcontractors and contractors are not something that we typically like, we would consider and we would look at possibly doing yellow iron. So big contracting, tractors, cranes, and things of that sort. Obviously, there's other tidbits in there, but essentially, yes, we'd look to finance any type of equipment that is kind of in our wheelhouse that we like, and the inventory.
Okay, so let me give you an example if I correct. Correct. So let's say, for example, the client that we talked to yesterday, right? She has the kitchen cabinet business, and she saying that right now she has over $2 million worth of cabinet stored in the warehouse. So is that something that you can utilize it to fund her?
So when I mentioned the AR having to be, there's something there. So we would go 50% of the AR line. Because we can't get to the AR, because we can't fund the account receivables, then we don't do an inventory only.
Okay.
Like I mentioned earlier, we do have resources where if you're looking for, or if your client is looking for an inventory only, Alan, like I've done in the past, I'd be more than happy to make an introduction.
Absolutely. Let me ask you another question, then. So many of us are new to AR funding, right? So we can definitely go out there to look for this type of client, but what kind of guideline that you can share with us so that when we go out there, we can actually filter out this type of client first before sending it to you?
Yeah, essentially how I put it in just the simplest terms is any business that produces a service, that provides a service or produces a product and ships the product, provides the service, ships the product, and invoices, and waits to get paid. They typically get paid 30, 60, 90 days. Those are the clients that we are talking about, accounts receivables. When a company, like I said, provides a service, whether it may be commercial cleaning, things of that sort, staffing agencies, if they are funneling out the money first, up front, and then charging their clients and then waiting to get paid. Manufacturers do this all the time, staffers, some of those kinds of service providers. Those are the ones that we are interested in helping, because essentially we are, instead of them waiting 30, 60, 90 days for their clients to pay them, we are coming in and advancing up to 85% of what is owed to them so that they get it faster, sooner than the 30, 60, 90 that they typically wait. We've helped everyone from the aerospace industry, apparel, arts and supplies, chemicals, fuel distribution, refineries, metal processing, office furniture, and any business that does business with other businesses. So one of the things on that point there was no retailers, so no business to consumer. If they're dealing with consumers, they don't have accounts receivables because they probably usually get paid on demand. And those are the companies that we don't finance. Those are the instances that we don't help.
So it's mainly a B2B business.
Absolutely. Only B2B.
Can you give us some tips on, how to find this type of clients, or what should we look for?
Yeah, so one of the key tales is if you ask that question, do you have accounts receivables? Everyone knows not everyone may, but if a business has accounts receivables, they'll know exactly what you're talking about. One of the things that I've done is I've looked for networking groups in these industries. And one of the major ones that always have ARs are manufacturers, right? So these businesses produce a product for another business that they ship out. So they get a purchase order, produce the product, ship it, and send it with an invoice. Those are the companies that we like. It's the bigger range of clients. So when you're in front of clients that are doing maybe 6 to 10 million, those are probably companies that are doing business to business. And those are the ones that you can get in front of. And a simple question is always, what does your accounts receivables look like? What is outstanding? And once they start telling you 500,000, 600,000, $1 million, those are the clients that should ring a bell for you and sell to capital.
Very good. Um, everyone, if you have any questions, feel free to unmute yourself and ask. Okay, so if I will be just continue to have the conversation with Vincent right here. So if every time when you feel that you have something to ask, feel free to unmute yourself and ask. Vincent, there's another questions that oftentimes we run into. So looks like account receivable, it's a company already produce a product and sell it to someone else and just waiting for the monies to come back. But what if a company that needs the money to start out to produce that product? I think that is called purchasing order. Am I correct saying that?
Yeah, that's correct. And those are we don't finance those. Essentially what we do is we put a UCC filing on the invoice. And this is why we're allowed to do these things and secure ourselves. When I say no issues with personal credit, no issues with BKs, or very little to no issues with these, you guys are probably scratching your head like, this is so risky. And you're right. It is risky, and how we protect ourselves and the money that we loan is it's got to be very, very detailed on the process of how they get paid. So if there is no product to be produced, then we don't fund our money, because if the business or the client tanks, how do we get our money back? So that's the hard part for purchasing orders. There are other companies that do PO financing, factoring financing, but we do not. So what we really look for are those clients that, like you perfectly said, Alan, they produce a service, they provide a service, produce a product, ship it out, send an invoice, and basically sit on their hands and wait to get paid. Those are the clients that we're looking to help. And once you hear those tall tales of ARs and how do you get paid, and they start telling you those things, then those are the ones that Delta Capital would love to kind of dive in and talk more to.
I see. Good. So normally, how does this type of loan work? So let's say you upfront 85% of the AR. Do you give them a lump sum? Do you give them in change? What would be the interest? I'm sure that a lot of people is going to ask you, what would be the interest rate looks like? In that nature. Can you touch up on something like that?
Yeah, so the way it works is essentially we give access to our state-of-the-art portal where clients would upload the invoices that they want to be financed. So these invoices would be financed up to 85% potentially, and the money is wired into their account next day. Typically, our process to get from start to finish is 30 days. So if a client is looking for quick funding, it can take, on average, 30 days. It could be faster, and it could take a little longer. It all depends really on how hungry or how prompt the clients are with our simple forms here. So in order to start the process to get approved for the facility, then that takes about 30 days. Once they're in, clients can then upload their invoices that they want financing for. And the money is wired into their account next business day. Interest rates are off of SOFR, so they're not off of prime. It used to be called LIBOR, but it's now SOFR, and it's something you guys can Google. It's on the daily exchange rate. It's something that you guys can Google and see what the SOFR is, and it's typically around, I would say, maybe 7 or 8 plus SOFR.
Okay.
So these are riskier deals. These are not, remember when I said these are kind of the bridge loan to kind of help them get back to traditional banking, traditional lending. These are going to be this is going to be more expensive than your Bank of America deals, your big bank deals. It's going to be more expensive, but because it's riskier. If they're already getting turned down by other banks, it's for a reason. So we're here taking the risk, and with the risk come higher fees.
Absolutely. So again, since you mentioned about Bank America or the big boys, right? So touch up a little bit, because I'm sure that is a very interesting topic, especially today. Probably not just the AR funding, but also other type of commercial funding. Also, a lot of people talk to us, hey, why not just go to Bank America? Why do I have to go to U Sequoia? So Can you
Yeah.
let us know your point of view since you're in the banking industry for a long time?
Yeah, my opinion is what happens is banks have a threshold. Banks have a cash flow, what they call a debt service on their cash flow, which they cannot. A business must make a dollar 25 for every dollar that they spend, and in some cases they don't. And what happens is their guidelines don't change so much as it's all federally monitored, but they could shy away from certain industries because of things like this. So like when COVID happened, right? The trucking industry kind of froze up. Restaurants, and I mean we can only imagine why, right? Restaurants, their doors. Some restaurants had to close their doors, takeout only. So obviously, banks weren't lending to those that it's getting harder and harder as their sales are declining. But what happens when interest rates rise? Their minimum payments are going to be a lot higher than they were at a 7% versus a 3% loan, right? So back then they were doing loans at 3%. Now it's 11%. It's the same thing with homes. You could afford a bigger home with a lower interest rate or more money because your payment's lower. It doesn't cross over your debt to income, right? So that's what happens as rates go up. Companies now are forced to. They could afford less and less as rates go up because the minimum payment is higher. And banks have a threshold where they're not going to put a business into jeopardy of overexpanding themselves, over leveraging themselves. So that's happening more and more. As these rates rise, a business could qualify for, let's say, $500,000 in a line of credit if that interest rate was 5% a year ago. But now that interest rate is 10%, 9%, if they max that out, that minimum payment is going to be a lot higher than it would at 5%. So then therefore they are declined, even though they've done nothing different. Maybe they didn't lose in sales. They've done nothing different. It's just the fact that minimum payment it's a lot higher than it would be at 3%. So banks would be reluctant to lend on that.
I see. Yeah, definitely. Let's get back to the AR funding right here. So I understand that as a lender, you guys also verify who the customer is from the client. So let's say a service provider, he's selling some sort of service or some sort of product to the end buyer, and you do need to verify who are those people that buying those products, right? Do you?
Yeah, yes, they go through a due diligence process, which my team handles in the back end. They're going to make sure. I mean, anyone, it's pretty standard stuff. Anyone can say they have $1 million in monies that are owed to them by company A, B, C, and D. We just want to make sure that those companies A, B, C, and D are real companies, how long they've been in the business, and it's not a lengthy process. It's not a hard process. So it's it's a very streamlined process. Again, we've been doing this for 40 years. This is a father and son company with the son at the helm now as the CEO, and he's a great mentor. And we're here to kind of be that alternative lending source. And I'll be honest with you, there's some businesses that just don't want to deal with traditional banking because of all the covenants they need, all the things they need to provide, personal taxes, business taxes, and with the more information that comes up, the more issues that can be found. But essentially, yes, there's some due diligence on who the business clients are, but we take care of that on our end.
So meaning that there are chances that you would not fund the AR if you do not like the end buyer. Is that right?
Yes, it just depends on, it depends. It just all depends. If the client has, 5 businesses that owe them, $500,000 each, and, and those 5 businesses are very, very new, like they've been in business for 2 years or 1 year and they already are in debt $500,000. That's pretty risky, right? But business owners don't usually extend that much out to new businesses. If you can imagine, if you are business A, I'm business B, we've been doing business for 30 years. You're probably going to say, look, yeah, I'll produce this for you and give you 30 days to pay me back, and the bill's going to be $500,000. But because we've been doing business for so long, I'm trusting in you, and I trust that we've done this for 30 years. There's no issues, right? But if you are producing something and I'm brand new as a client to you, you're probably not going to front me $500,000 in product up front. That makes sense?
Right. Okay.
So yeah. So yes, there's possibilities where we're not interested in some of these clients, but again, that's almost here nor there, and that'll kind of fog the funnel. And I think the main thing is to focus on whether or not they have ARs, and to get them referred to you, get them referred to me, so that we can do the due diligence on our end as fast as possible and get them to the right place if it's not us.
Now, are there any so-called right client for you? Give us some tips. What type of clients to look for?
Yes. So manufacturers, these are typically these manufacturers. I'll never walk into a manufacturer place and say, hey, give me one of these, because I'm a consumer. So manufacturers are huge because, one, those are business to business for the most part. I would say 99% of manufacturers only deal with other businesses. And typically those guys are extending those ARs, those 30 days, 15 days time frame where they're waiting to get paid. Manufacturers are huge. Apparel companies, any kind of wholesale distributing companies where they're distributing product and sending an invoice and waiting to get paid. So the right client is anyone, again, that works with business to business and waits to get paid after they've already did payroll, they've already produced the product or provided the service. Those are who we're looking to help. Of course, we don't help them all, like doctors, lawyers, subcontractors or contractors, but those are 4 out of a ton of businesses that do business with other business and only.
So do you have?
So I think.
Do you have the right type
So
of
I think
ARs
that's the main.
Sorry, go ahead.
Go ahead. Sorry about that.
Do you have the right type of AR we should look for? You mentioned something about 30 days, 60 days, 90 days, 120 days. So,
well,
I mean, what?
Yeah. So we only finance what's in between the 30 and 90 days, right? There's some businesses that may have ARs that go past the 91. We just won't look at that. We will only focus on what's at the 30, 60, 90. So no need to ask, no need to worry if there are receivables that are past 90 days. We would just look at, if you want to dive in, yeah, you can ask how much account receivables outstanding do you have, and what of that is past 90 days. So that way, then that's not going to count for anything that we will finance. But we will still talk about providing that line of credit for the client, and help them with that and clean that up.
So you mentioned something. You mentioned line of credit. Can you share with us a little bit about how that loan works? Yeah.
So if within, like you mentioned, those ARs, if if the outstanding is $1 million. That line of credit to them, or their accessible funding amount, would be $850,000. Now that would fluctuate, right? So that would be their facility size. 85% of. So let's say within the first 30 days they are owed $250, and then between 30 to 60 days, there's companies that owe him a total of $250,000, and then between 60 and 90 days, there are companies that owe a total of $500, getting to that $1 million. We would provide that line of credit of $850,000 that clients can then send us those invoices, and we will provide 85% of that. and it'll go all the way up to 850,000.
So do you give them the 850,000 as a lump sum?
If they provide us $1 million in invoices and want 850,000, yes, if everything else is good, we would wire them 850,000 as a lump sum.
And what is the term for the loan? Is it a year, 2 year, 5 months? What is it?
It would probably be a 2 to 3 year loan. Then we can always revisit it. Yep.
So let's say right now they have an AR for $1 million and you give them 850,000. Now they have another AR coming, let's say next month, they have another AR. So can you keep funding them like this? Or is that a limit up to 5 million? Is that right? Is that right? How does it work?
The limit would be up to their facility size of 850,000. If their ARs continue to grow, then yes, we could always revisit that and see if we can extend that to go up to 1 million, 2 million, 5 million if possible. Yes.
I see. And how do they pay you back? Do they pay you back on a monthly basis, or how does it work?
So as their invoices get paid in, they are going to an account that we have. It's kind of like a sweep account. So it's still getting paid to them. We are just on that account also. So the monies come in to get swept into our account. So if they owe us 850,000 and they get $1 million in a month as payment, it sweeps to us and we take out the fees minus the interest rates, et cetera, and then we wire them back the overage of that amount. So if the total fees were another 50 grand, then we're wiring them back 100,000 out of the 850 that they owe us, and the fees were 50,000. So 900,000, and we wire them back 100,000. Obviously, there's a lot of other tedious stuff, but I'm just kind of doing it as simple as possible and using simple math just to try to get our heads wrapped around that.
Great, got it. I don't have much questions. I think I ask a lot of questions right here. Anyone in the group, feel free if you have anything. So again, it might be new to you, but again, this type of product is to open up a door for a lot of us that, hey, what is the possibility out there? So when we come to commercial lending, come to Sequoia, the goal is to expose to you to many, many different products that you can serve your client. Again, this is not traditional funding. Yet a lot of business owners out there needs this kind of funding, and it's not that difficult. And all we needed to do is just to fill a simple scenario form, fill out an application, and submit some ARs. And they don't even need to see the financial. Is that correct, Vincent? You don't even need to see the bank statement and things like that, do you? Or
no bank statements, no tax returns. What we do need are last year's profit and loss and a balance sheet. So profit and loss statement, balance sheet, and most recent year-to-date profit and loss and balance sheet. So it's very easy. And of course, we need a aging AR report and aging accounts payable report. So like people owe them money, some businesses have a rolling account payable where they owe other businesses money. So it's pretty simple. Those are the only things that we pretty much need for them to get started and upfront. And of course, our proposals are at no cost. So if this is something that we feel like we could do, we'll draw up a proposal and we'll let the client decide, and there will be no fee upfront to that client for a proposal.
Very good.
And this is very different than your standard commercial real estate. It's different. So when you're out there pounding the phone, pounding the pavement, and you're talking about, are you looking to refinance? Are you looking to stop renting and look for a different? Maybe some businesses are already established. They already own their property. They're good, and this is another tool for you to use and start asking for working capital needs. Have you been turned down by a loan from a bank recently for working capital needs? And a good way to funnel these out is, again, it's ARs. What do your outstanding account receivables look like? And if they say, well, typically it's $1 million, $2 million, those are good. Those are great. Those are the ones that we want to talk to, and we can figure out the rest. There's no need to, well, what kind of clients are there? There's no need for that. Until things get super busy, those are calls that I'd love to field all day and figure out do the legwork for you guys. But as simple as that, and this one question that's top of mind is, what do your account receivables look like?
Great. Now, you did mention profit and loss statement, year-to-date profit and loss statement, 2021 profit and loss statement. Now, do they need to be certified by CPA?
They can be internal.
Okay.
Yeah, the last years, they can be internal. They don't need to be certified. They can be internal. We have a very good due diligence process where we'll make sure to take care of that stuff on our end. But yes, they can be internal.
Okay.
Meaning no. Yep, they don't need to be certified.
And do you care about clients' credit score?
We do, but we have a stomach for issues, right? We have a stomach for issues. So it's not that we don't care, but we're not going to say, we're going to turn down a deal because the client has filed for bankruptcy last 2-3 years ago. You know what I mean? So that's not what causes heartburn. For us, is how they bill their clients is what causes the most heartburn. If they say, yes, I have account receivables, the next question is, do you take deposits? Do you take upfront deposits? That throws a wrench in the deal here. But so personal credit does not give us too much heartburn.
What about foreign nationals that has business here in the United States?
They have to have a partner that is a citizen of the United States. There has to be an owner that is a citizen of the United States.
Okay, got it.
Yep.
Well, thank you.
I'm here. If you guys have questions that rolled up to you, please feel free to forward them over, and I'll answer them as best I can. I appreciate you, Alan, for the time here and giving me the exposure. I appreciate everyone on the team here, Carla, Judy, Tyrone, Terry. Thank you very much for attending, and I'm here to help.
Absolutely. Well, thank you so much, Vincent, for a lot of useful information for all of us. So team, again, this is AR funding. It opens up another door for us. So go out there, start talking to your business people, and you will be surprised how many of them are actually waiting for you to get them the funding that they needed. Okay. So if there's no more questions, we're going to end up tonight's presentation. And next week, we will see you again for another episode of Sequoia Lending's presentations. Okay, guys, good night.
Thank you, Alan.